Ever find yourself looking at a company's financial report and thinking, what are they really trying to tell me?
It can feel like you need a decoder ring sometimes.
Exactly. And that's what today's deep dive is all about. We're tackling IFRS 5, the accounting standard that sets the rules for how companies report asset sales, and those spin-offs or shutdowns known as discontinued operations.
Because businesses, just like people, go through these major life changes. They might decide to sell off assets that aren't performing well or streamline their operations by parting ways with entire business segments.
And IFRS 5 wants to make sure those big decisions are reported transparently.
Absolutely. Whether you're a seasoned investor or just starting to decode the language of business, understanding IFRS 5 can give you some serious insights.
So let's jump right in. We're talking about a company making the decision to sell off assets or even entire parts of their operations. Help me understand this. Why should someone who isn't an accountant care about this?
Because those decisions and how they're reported can tell us a lot about a company's financial health. Are they making smart choices? Are they being transparent about their challenges? IFRS 5 helps answer those questions.
Okay, so no more sweeping those unwanted assets under the rug. IFRS 5 is like the financial referee making sure everyone's playing by the rules.
Exactly. And it ensures companies are presenting a clear picture of their financial position to investors and analysts.
So let's say a company realizes a piece of equipment they owned isn't cutting it anymore.
Right, like that example we have from the source material about Polo and their outdated machinery. IFRS 5 comes in and says, okay, you're thinking about selling that old machine, but how serious are you?
Because I imagine there's a big difference between casually listing something on the online marketplace and having a concrete plan to sell, right?
A huge difference.
Mm.
And IFRS 5 sets the bar pretty high. For an asset to be classified as held for sale, it's not enough to simply want to get rid of it. Management needs to be committed to the sale. We're talking action, not just intention.
So what does that commitment look like in the real world?
They need a solid plan. They need to be actively seeking buyers, potentially bringing in brokers, and most importantly, they must be willing to sell at a reasonable price.
Show me the receipts, as they say. So for Polo and their machinery, it wasn't enough to just think about upgrading to a newer model.
Nope, not even close. They had to prove they were serious about selling that old machine. That means setting a realistic asking price based on market value and actively searching for buyers, maybe even considering offers from brokers.
Got it. So there has to be a concrete plan in place, and the company has to be realistic about what they can get for that asset. But are there other criteria they need to meet?
You're right, there are a few more boxes to check. That asset has to be available for immediate sale in its present condition, meaning they can't be planning to shine it up or make any improvements before handing over the keys. It needs to be ready to go right now. And they have to be actively marketing the asset at a reasonable price, not some pie-in-the-sky figure they're hoping to get.
So no dragging their feet or waiting for that miracle offer.
Exactly. And the sale needs to be expected to close within a year. IFRS 5 is all about keeping it real. It wants to make sure that held-for-sale classification truly reflects what's happening with that asset.
It's like the difference between saying you're going to run a marathon and actually lacing up your shoes and starting a training plan.
I like that analogy. IFRS 5 wants to see action.
Okay, so we've covered the criteria for classifying an asset as held for sale. But once that classification is made, don't we need to figure out how much that asset is actually worth?
Excellent point. And that's where things can get a little tricky because the value a company thinks an asset is worth and what someone is actually willing to pay for it aren't always the same.
Which brings us to the often dreaded topic of impairment, right?
Right. But it's not as scary as it sounds.
Okay, so we're talking about impairment. Help me understand this. It sounds like something only accountants need to worry about.
Not necessarily. Impairment is about transparency. It's like finding out that vintage record collection you inherited isn't worth as much as you thought.
Disappointing, to say the least. And I imagine it's a lot more than just disappointing for a company when it comes to their assets.
Right, because we're talking about potentially significant sums of money here. And when a company has to admit that some of its assets are overvalued, it impacts their financial statements, their bottom line.
So how does IFRS 5 make sure companies are being honest about those valuations?
Well, IFRS 5 sets out a clear process for measuring and reporting impairment. Remember our friends Polo and their outdated machinery?
How could I forget?
IFRS 5 forced them to compare the machine's carrying amount, what's on their books, to its fair value, less any disposal costs.
Hold on, let me make sure I'm following. The carrying amount is like their original cost, but adjusted over time for depreciation, right?
You got it. Like a car losing value as the miles add up.
Makes sense. So that makes fair value what they could realistically sell it for in today's market.
Exactly. You have to consider things like the asset's condition and what buyers are currently paying for similar items.
But then you also have to factor in those disposal costs.
Ah, yes. Don't forget those. Disposal costs can be sneaky.
So what kinds of things fall under disposal costs?
Think of it as any costs associated with actually getting rid of the asset, things like dismantling it, transporting it to the buyer, maybe even paying a broker to help find that buyer. All those expenses eat into the final sale price.
Got it. So let me see if I've got this straight. Polo has to look at their old machine and figure out the fair market value, what they could reasonably get for it minus any costs they'd incur to actually sell it.
Right.
Then they compare that final figure to what's listed as the machine's value on their books, the carrying amount.
And if that fair value is lower than the carrying amount,
That's where the impairment charge comes in.
bingo, they have to recognize that loss on their income statement, effectively admitting that the asset isn't worth as much as they initially thought.
Which, to bring it back to IFRS 5, forces companies to be realistic about the value of their assets.
Exactly. IFRS 5 says no more pretending those assets are worth more than the market says they are.
I'm starting to think IFRS 5 is the accounting equivalent of tough love.
Huh. There might be something to that.
But that honesty is crucial for anyone trying to understand a company's financial position. It's all about painting an accurate picture.
Couldn't have said it better myself.
Okay, so we've talked about the theory, but let's go back to Polo and their machinery from our source material and use that to illustrate how this all works in practice.
Great idea. So after accounting for depreciation, their old machine had a carrying amount of $220,500.
Right.
But they determined its fair value, what they could realistically sell it for, was $200,000.
But we can't forget about those disposal costs.
You're right. They also estimated the $1,000 in costs to dismantle and prepare the machine for sale.
So that means their fair value, after deducting those costs, was actually only $199,000.
You do the math. And since that's lower than the $220,500 carrying amount.
Red flag. Looks like we've got an impairment charge on our hands.
Exactly. Polo would have to report a $3,500 impairment loss on their income statement. That's the difference between the lower fair value of $199,000 and the higher carrying amount of $220,500.
Which, to bring it all back to IFRS 5, ensures that companies are playing it straight with their financials.
Transparency is key.
All right, deep divers, time for a quick knowledge check. Let's see if you're following along. Imagine you're looking at France & Co's financials.
Ooh, I love a good knowledge check. Always a good way to make sure everything is sinking in.
So France & Co bought a building a while back for $400,000. They've decided to sell it, gone through all the necessary steps, and it officially qualifies as held for sale under IFRS 5. At the time they decided to sell, the building's carrying amount, what's on their books, is $213,000. However, after doing their due diligence, they determined the building's fair value is only $200,000. And to add insult to injury, they'll have to pay a real estate agent $10,000 to finalize the sale. So here's the million-dollar question. What's the adjusted amount of that building that France & Co should report on their balance sheet? Take a moment to think about it.
Don't worry, we'll walk you through it. No need to pull out your calculators just yet.
All right, deep divers, let's break this knowledge check down together. Remember France & Co and their building. They need to figure out what's lower, the carrying amount of $213,000 or the fair value after we subtract those pesky disposal costs.
And we can't forget about those real estate fees. Those are definitely part of the disposal costs, which means the price they'll get for that building is even lower.
Right. So we start with that $200,000 fair value, but we've got to subtract the $10,000 real estate fees, and that leaves us with
$190,000.
And since that's less than the carrying amount of $213,000?
That's right.
Looks like France & Co has to report that $190,000 figure on their balance sheet.
And they'll have to recognize that $23,000 difference as an impairment loss.
Really?
Ouch.
It's another great example of IFRS 5 doing its job, making sure companies are presenting their financials honestly, even when it's not exactly good news. But we've only covered half of what makes IFRS 5 so interesting. We've tackled the sale of individual assets, but now get ready to dive even deeper as we explore discontinued operations.
This is where IFRS 5 gets really interesting. Now, instead of just selling off a single asset, we're talking about a company deciding to say goodbye to an entire chunk of its business.
Okay, that sounds pretty dramatic. Paint me a picture what qualifies as a discontinued operation.
Imagine a company that makes both cars and bicycles, and they realize bicycles just aren't their thing anymore. Maybe the market's too competitive, or maybe electric scooters have taken over the world. Whatever the reason, they decide to completely shut down their bicycle division.
So we're not just talking about selling off a few old bicycles, it's the whole operation. The factory, the inventory, all of it.
Exactly. And just like with those assets held for sale, IFRS 5 has rules about how these discontinued operations are reported in financial statements.
Makes sense. Investors need to be able to see what's going on with those discontinued operations separate from the company's main business.
Absolutely. They need to know which parts of the business are here to stay and which ones are riding off into the sunset. That's why IFRS 5 makes companies present the financial results of discontinued operations as a separate line item. They have to show the total profit or loss from those operations right there on the income statement.
So it's like they're saying, here's how our car business is doing, and oh, by the way, here's how that whole bicycle venture wrapped up.
You got it. But IFRS 5 doesn't stop there.
There's more.
Oh, yeah. Investors want all the nitty-gritty details, so IFRS 5 makes companies provide a detailed breakdown of the discontinued operations revenue, expenses, and any gains or losses from selling off the assets. And they have to include all of that in the notes to the financial statements.
The notes to the financial statements, that treasure trove of additional information.
Exactly.
So even though it's a discontinued operation, IFRS 5 makes sure the financial details don't just disappear.
Absolutely not. IFRS 5 is all about transparency. And speaking of transparency, we also have to talk about the statement of cash flows.
Okay, I'm listening. How does cash flow fit into all of this?
Well, think about what happens when a company shuts down a division. There's a ripple effect on their cash flow.
Like a financial earthquake.
Kind of. They might receive cash from selling equipment and inventory, but are probably also paying severance to employees, maybe even penalties for breaking contracts.
It's like the financial aftershocks of closing down a business.
Exactly. And IFRS 5 wants to make sure investors can see those aftershocks clearly. That's why IFRS 5 says companies have to report those cash inflows and outflows related to the discontinued operation separately from everything else.
Wow. It sounds like IFRS 5 is the really detail-oriented record keeper of the business world, making sure nothing about these discontinued operations gets lost in the shuffle.
That's a great way to put it. IFRS 5 just wants to make sure investors have a clear and accurate picture of what happened and how it all impacts the company's financial position.
This is all incredibly insightful for investors trying to analyze a company from the outside, but what about everyone else? How does understanding IFRS 5 benefit someone who may not be a financial expert but interacts with businesses every day?
That's a great question, and it gets to the heart of why we do these deep dives. Understanding IFRS 5 gives you a new way to look at a company, and its decisions you get to see beyond just the numbers.
Okay, I'm all ears. Give me an example.
Let's say you're thinking about investing in a company, or even applying for a job there. Knowing about IFRS 5 and how it works gives you a new framework for evaluating how that company has managed change and made strategic decisions.
So, if a company has a history of starting new ventures that quickly become discontinued operations, it might be a red flag.
Exactly. It's all about connecting the dots. Maybe that company bragging about its rapid growth has a history of making acquisitions that just don't work out and end up as discontinued operations a couple years later.
IFRS 5 gives you the tools to look beyond the marketing and see how they're really doing.
Exactly. And that's what's so great about understanding this stuff. It's not just about crunching numbers. It's about understanding the language of business and using it to make smarter decisions, whether you're an investor, an employee, or just someone who likes to be informed.
That's what we're all about here on The Deep Dive, giving you the knowledge and confidence to decode the often complicated world of business and finance.
So the next time you're reading a business article or hear a CEO talking about restructuring, remember IFRS 5. Don't just skim over those financial terms. Think about what the numbers are really telling you. What's the story?
Because sometimes the most valuable insights are hidden in plain sight. That's all the time we have for today, but we'll be back next week with another deep dive. Until then, keep exploring, keep asking questions, and we'll see you next time.